Really the big news maker today, isn't it? Let me welcome in Dipen Sheth, who's joining us right here in the studio this morning. Great to have you with us. Let's talk about Indigo first. I mean, look at the market reaction. You know, we've all been discussing this. Yes, corporate governance issues. Yes, long drawn-out battle. But the impact on the stock, regardless of the fact that it's a company that's great valuations, doing well, has had no complaints till now. How would you digest this news?
So we'll be watching this space closely. Any kind of spat at the ownership or sponsor or promoter level is a problem.
Sure.
God knows Mindtree is going through some such thing right now. Internal management quality is wonderful. The quality of the business is beyond question. Just like it is in Mindtree. But when there is an ownership issue and who's really going to drive this ship, if that's a question. So the Sena is good, but if I'm not sure about the Senapati, then I don't know what this army is going to do. So that's a global big picture 40,000 foot comment. But I think somewhere down the line, both realize that they will destroy value if the spat continues.
Sure.
I hate to take sides here or suggest a way out. It's not my mandate or brief. But I think if one of the litigants, if I may say so, respectfully withdraws and decides to let the value remain intact and maybe agree to encash the value. I don't know which one it should be, and there are various schools of thought around that. And frankly, we need to get into the details. But anything that disturbs the mood of two Senapatis is going to rattle the Sena. That's the fear we have in Mindtree. That's the fear I think we should have in Indigo. And we should wait for a little bit of this of the news bites to die down and for them to put their heads together and work a way out.
Aviation's just becoming, so interesting, Dipen, because we've seen what's happened with Jet.
Yes.
Air India, they're talking divestment now, but anyway, let's keep that aside for the moment.
Right.
Which leaves you on Indigo, on the back of growth potential, on the,
No, it doesn't. There's Spice Jet. That's another wonderful management.
Of course.
Let's not forget Ajay Singh.
Yeah, so then is that the only beneficiary in this case?
No, so it's not that your loss is my gain, first of all. It played out that way with Jet, which was imploding anyway.
The stock is playing out that way. But.
Right. So well, in the case of Jet, their horrible operating cost structures and their over leverage and their reckless expansion, if I can call it that, coupled with some well-founded concerns on corporate governance, led to the blowout, I would say. Or I don't think we have a similar problem in, let's say, SpiceJet at all.
Of course.
I don't think, in fact, I see a money spinner in Indigo. And I'm willing to go out on a limb and say Air India's franchise, its slots, its multi-location advantage across India and the world makes it a great case for divestment and efficient management, which it isn't right now.
Because the sector needs to grow. If there's so much untapped potential.
It's not about the sector needs to grow, Abba. I think the bigger deal is that the sector can grow.
Exactly.
This is one of those sectors for India from a 5 or 10 year perspective, where anywhere between 5 and 15% volume CAGR 5 and 15% volume growth every year is feasible. Something like a 10 to 12% volume CAGR is easily achievable for a decade. What are we talking about?
Yeah, absolutely.
Dipen, after the strong performance in Q4, TCS has started off on a fairly slow pitch. How have you read into the numbers? And experts are saying that there's going to be more headwinds for the stock ahead. We're talking about the overall environment that they're operating in. The rupee and even BFSI now, which everyone was watching so closely, has slowed down.
Yeah, so you can tick all the negative boxes if you are a pessimist on TCS. The US has had a great 3-year run on macros. TCS has had an even better run, if you look at it that way. It's now a $20+ billion company. You are looking at hopefully India's currency not continuously depreciating in the foreseeable future, although the jury is out on that. You're looking at digital disruption hitting the sector continuously over the last 2 years, and a lot of people, getting it and not getting it and all that kind of thing. So if that's the lens you want to look at TCS through, and of course the upcoming talent crunch and shortage for on-site talent in the US, and you can keep finding gaps, and the fact that TCS continues to be a services play rather than a product play like the glam dogs in the innovation space within the slice within IT.
Yeah.
However, you've got a $20 billion pure services company with an interesting layer of consulting, which is highly respected in the US. When we traveled through the US, I think less than a year ago, and spoke with stakeholders across the industry value chain, whether they were customers or competitors, consultants, global innovator companies, and so on, there was uniform respect for the management quality and the delivery efficiency and the reliability of TCS. Okay. So I can say this, that within India's software space, TCS is the Mercedes-Benz of delivery. I don't see that changing. Now they've got a $7 billion digital practice as well. Yes, legacy is slowed down, and in fact, it's just about flat year on year. And you'll crib about, the headline growth not being 3% and 2 point something, the margin slipping from the 26% band to somewhere around 24% and all of that. But a $7 billion digital slice, 21x valuations, you should buy the dip. You should buy the little softness in the reporting. I don't know how the stock is today. I haven't taken a look, but
it's just around the 2100.
Yeah. So who's selling? Nobody's selling, right?
Yeah.
You can crib all you want on TCS, and a great company with slightly higher or a little higher than industry valuations is not to be sold. There is no sign that the greatness is going away.
What about your views?
Hold that thought. Once you see greatness going away, you may not want to give a premium valuation. That's played out in iShares, let's say. If I randomly pick companies from other sectors also, it's played out for Page. But it isn't playing out for TCS because they continue to deliver within a certain range. It'll always be a half or a 1% up or below what you think should happen. But there's no breakdown of the thesis at all.
Is it playing out for Bajaj Finance?
So there's a contradictory thing coming through. So first of all, the disclaimer there is we don't have them under coverage, and we've been trying to figure them out. And I think this is a company that ticks all the boxes, just like TCS.
Right.
And while we don't have them under coverage and we don't have a formal recommendation, there is nothing to my mind which suggests that a little bit of caution reported by Mr. Bajaj should be taken as a 5-year commentary.
Sure.
So he'll go through ups and downs. The business will go through ups and downs. But look at that growth. Well, look at that growth and look at the sustainability of that growth, and look at that growth coming without spoiling the quality of the balance sheet.
Well, there's a thought that came in from one of our other market participants saying that even though there were small ticket loans, that we would see a risk of default even at that level, that it would filter down. So, I mean, it's again just a cautionary mention.
Yes, of course. So they just don't want expectations to run ahead of reality.
Yeah.
And if you have smaller ticket size loans, remember the risk is granular and mostly manageable there out of process rather than, solid person-to-person underwriting skills. The thing that happens in a 500 crore corporate loan, the kind of risk management skills needed there are completely different from the risk management skills which are needed in a 10,000 rupee mobile loan. And the 10,000 rupee mobile loan can actually be automated and be powered with artificial intelligence and risk analytics in a way that the 500 crore corporate loan cannot be. So I'm much more bullish on the prospects for Bajaj Finance than, let's say, on the prospects for many of the corporate banks which are now admittedly healing and healing very fast, I must confess.
On that note, I think financials is really what everyone's betting on in terms of, a certain segment within the broader pack. Hoping that some of the monetary stimulus will start to kick in, hoping that the cleanup is behind us, and that's really what market men seem to be betting on to take things forward going ahead. Would you agree, or would you still be a little cautious?
No, so at 1/3 or so of the lead index, financials is where you must be focusing very closely.
Yeah.
But as this market has taught us for the last few years, it's not going to be
broad-based.
A broad-based move. It's not going to be, and you will see divergence in performance. You will see divergence in valuations, and you will be puzzled to see even more divergence in their commentary and in the way the stocks eventually perform. And you will continue to be puzzled by the relative outperformance of what is good, but you feel it's too costly. And that has played out for Bajaj Finance, let's say, for example. It will continue to play out for some of the bigger banks, and I think it's time that Axis and ICICI Bank got back to their old premium valuations.
Sure.
I think Axis has many more miles to cover on the valuation front, although some brokers have recently said that is the big valuation re-rating game over.
Yeah.
So I think there are many levers at Axis, for example, and of course at ICICI Bank. So whether it's growth, whether it's balance sheet healing, whether it's sharpening of core metrics as you move forward, Axis, for example, after the big blowout on asset quality, now has got less than 2% of their loan book to BB and below quality. I mean, we see even here on, for the next 2 years, provisioning or credit costs falling appreciably over the next 2-3 years. Now you have a visionary leader in charge, an inspirational leader who's being able to attract talent from, dare I say it, HDFC Bank.
Right.
And that's inspiring as an observer.
Sure.
You know.
What about an IndusInd?
Yeah, so IndusInd is a very, very interesting case. There's no question on management quality there. They've had that accident with IL&FS. But they've been running a brilliant operation for more than a decade now.
Right.
They are reasonably valued, I must say. This is a very good opportunity to look at IndusInd all over again. Because by adding the Bharat Financial slice to their loan book, one, it gives them diversification and a high ROA, higher than their average ROA kind of loan book with relatively lower consumption of capital. Okay. Are they buying more risk? I think they are getting more opportunity. There are two ways again to look at this. They're getting far more reach into upcountry India. The opportunity for eventual cross-sell, I won't say right now, but eventual cross-sell of a whole lot of financial products down that channel is tremendous. They've been punished, God knows, enough for their accidents with IL&FS. And I think what is going to also happen is that as they transition to Ind AS, some of their, should I say it, bloated fee income reporting might get a little averaged out, but I don't think I'm worried on that. I think the big deal here is, can they keep a tight grip here on the slight shake-up that has happened in asset quality? And can Bharat Financial continue to deliver on what is clearly a very high opportunity lending slice, a lending vertical in microfinance? I think the next few years are going to be a very, very interesting phase to watch IndusInd Bank. I suspect there is going to be serious value creation all over again.
Nice.
What's the view, Dipen, when it comes to the FMCG space? We've been acknowledging the fact that there has been a slowdown in consumption. You had Marico, you've had HUL, you have all of them coming out and lowering their overall targets because of the overall setup. Do you believe that this is an opportunity to enter? Is there more pain?
I'm happy you asked this question because it's fashionable to beat FMCG now, saying that, oh, valuations are at 40, 45, 50 and all of that. Rural India is going through a slowdown, so FMCG will underperform. God knows it hasn't underperformed in the last 5 years or 50 years for that matter. So long as we remain, the broader comment on FMCG is that so long as we remain a consumption upscaling driven economy, any consumer business is set for a good time. That said, some consumer businesses have more cyclicality or vulnerability. Let's say, so a business like Symphony, I'm going outside FMCG to illustrate my point. Business like Symphony has more vulnerability to reported weather. A business like Voltas has more vulnerability to consumer sentiment because after all, it's end of the day discretionary spend. On FMCG, the big deal is that you need to look at quality of portfolio. I think Hindustan Lever stands out. There's just no comparison with any other. Hindustan Lever and Nestle, though we don't have Nestle under coverage. These two companies completely stand out. But and niche stories like Marico, the vulnerability on Marico has been that they haven't had a single very large product success or brand success for some time, but I think they're a very gifted management. And the advantage that they got over the last 6 to 12 months was the gradual falling off of the copra price cycle, which they played to advantage and delivered alpha for investors. But I don't think we should look at it purely from a copra cycle perspective either. So you do have high quality businesses, I must confess, like a Marico, like a Britannia, like a Lever, and you have to take your pick in terms of where you find the valuations comforting. I must confess that ITC at 40-45% discount to the sector, yes, I know it's sin industry and the stock has gone nowhere, but the valuation gap is now alluring. Okay, and if I can round up my views on the entire consumer space and not just FMCG, I must confess that despite the headline high valuations, a Jubilant Food Works for the sheer management quality and the reinvention of the business model over the last year and a half or so, And much of that is still to deliver, especially in terms of their digital evolution. And you have no idea what you can do. So they are a food tech company and a consumer company combined into one. And you have no idea of the addressable opportunity that they're looking at, the kind of levers they're pulling in terms of internal efficiencies, getting revamped and getting driven by digitalization, shall I say, of their business model. Much of that is yet to deliver. So the 37, 38x kind of valuation multiples that you might be looking at are not too scary. The stock has gone nowhere over the last few months. I think this is a good time to pick it up.
Okay. What are you making of the higher tax on FPIs, Dipen? Just to change tracks for a moment, 40% of them to be impacted. I see in your notes you've said it may not be a bad thing.
So that's again a slightly higher level comment. I've always been personally uncomfortable about the fact that I can invest in my markets at a tax rate which is different from foreigners. Level playing field, anyone?
Yes.
Yeah. So mutual funds are not taxed for the simple reason that they're pass-through instruments.
Sure.
As an investor in a mutual fund, I'm liable to pay short-term or long-term, whatever the case might be. I do feel that long-term capital gains of 10%, while it is regressive, is not significant to kill sentiment for investing. Okay, it is regressive. You should incentivize long-term investment in the stock market, given the very low penetration that equities have in our household savings pie. Maybe the thing to do is perhaps that maybe you take up the holding period to maybe 2 years or even 3, why not, and say we'll tax you at 0 rates for that. That is one suggestion I have for the government. The second thing is on the FPI bit, I want simplification. And I want FPIs to be treated the same way as, let's say, Indian corporates would be treated if they were to invest in the stock markets. And in fact, FPIs should be treated at par with mutual funds, insofar as that if mutual funds are pass-through instruments and the eventual beneficiaries of FPI holdings, if you cannot pass through the tax impact there, then you need to tax them as and when they book those profits in the stock market. And I'm okay with that.
Sure.
I don't think there is much to crib there. Having said that, I think overall on taxation, the budget has been a little harsher than it could have been. And I'm not complaining about the 42 or 43 effective 43 odd % on the higher tax slabs. I think a lot of the rich folks will crib on that. I think it's okay. I don't think it's a big deal. For me, the bigger deal is that the fat tail of taxability, getting more people in the tax net, the good work that was started by Aadhaar, by digitizing the IT or income tax infrastructure. So by giving infotech or IT infrastructure to the income tax setup. So IT in IT was a good idea. Aadhaar was a good idea. I think demonet was a good idea in terms of trying to get more people in the tax net. Putting a withholding tax of sorts on large cash withdrawals is a good idea. But there's a whole lot of people who are still outside the tax net and who are taxable. I wish the government would do something tight and something strong to get them into the tax net. Then maybe we can let go of the 45% or 43% tax rates.
All right, Dipen, it's been lovely having you with us in our studios. Thanks much for dropping by and giving us your take on taxation as well as individual sectors to watch out for. So yes,